The Goods and Services Tax, GST, Act 2017 created the legal framework for India's GST regime, replacing several indirect taxes with a common, destination-based tax system from July 1, 2017. About Goods and Services Tax, GST, Act 2017. The Goods and Services Tax, GST, Act 2017 introduced a common indirect tax framework in India, replacing a fragmented system of central and state taxes with a unified, destination-based tax on the supply of goods and services. Launch: GST was rolled out on July 1, 2017, marking a major reform of India's indirect taxation system. Taxes replaced, GST subsumed several central and state levies, including excise duty, service tax, VAT, central sales tax, CST, entry tax, octroi, and purchase tax. Nature of tax: GST is a multi-stage, destination-based consumption tax, meaning the tax ultimately accrues to the place where goods or services are consumed. Core objective: GST seeks to reduce tax cascading, simplify compliance and create a unified national market, reflecting the principle of one nation, one tax, one market. Goods and Services Tax, GST, Act 2017 constitutional basis. The 101st Constitutional Amendment Act, 2016 created the constitutional foundation for GST by changing how the center and states exercise their taxation powers. Article 246A gives Parliament and state legislatures concurrent power to make GST laws, while Parliament has exclusive power over interstate supplies. Article 269A provides for the levy and collection of IGST on interstate supplies by the center, with the revenue apportioned between the center and states. Article 279A provides for the GST Council, to be constituted by the President within 60 days of the commencement of the amendment. Article 279A specifies matters on which the GST Council makes recommendations, including GST rates, exemptions, threshold limits, model laws, and special provisions for certain states. Article 366(12)(a) defines GST as a tax on the supply of goods, services, or both, excluding alcoholic liquor for human consumption. Changes to 7th Schedule, the amendment redistributed taxation powers, while alcohol for human consumption remained outside GST and petroleum products continued under the existing tax system until brought within GST as constitutionally provided. The constitutional framework enabled compensation to states for revenue losses arising from GST implementation, followed by the GST, Compensation to States, Act, 2017. Goods and Services Tax, GST, Act 2017 need. Before GST, India had a complex indirect tax system in which the center and states imposed different taxes, making goods costlier and business operations more difficult. Multiplicity of taxes: businesses had to pay several taxes such as central excise duty, service tax, value-added tax, VAT, central sales tax, CST, entry tax, and octroi, each with different rules and procedures. Cascading of taxes: a tax could be charged on a value that already included another tax. For example, VAT could be imposed on a price that included central excise duty, creating a tax on tax effect. Limited tax credit: tax paid to the center could not be freely adjusted against state taxes, and vice versa, causing additional tax costs at different stages of production and sale. Different state tax rates: states had different VAT rates and exemptions, so the same product could have different tax burdens and prices in different states. Fragmented national market: different state taxes and interstate checkposts made movement of goods across states slower and more expensive. High compliance burden: businesses operating in several states had to follow different tax laws, registrations, returns, and procedures. Tax evasion: multiple tax systems and limited coordination made it harder to track transactions across states, creating opportunities for tax evasion. Impact on competitiveness: additional and non-creditable taxes increased the cost of Indian goods, affecting their competitiveness in domestic and international markets. Goods and Services Tax, GST, Act 2017 features. The Goods and Services Tax, GST, Act 2017 introduced a common tax system in which goods and services are taxed through a coordinated center-state framework. Multiple rate structure. The GST regime introduced in 2017 had four main tax slabs of 5%, 12%, 18%, and 28%, along with nil-rated/exempt supplies and special rates such as 3% for gold and certain precious metals. Compensation cess was additionally imposed on specified luxury and demerit goods. Dual GST structure, Central Goods and Services Tax, CGST, and State Goods and Services Tax, SGST, are levied on intrastate supplies. 18% GST equals 9% CGST plus 9% SGST. For interstate supplies, Integrated Goods and Services Tax, IGST, is levied by the center and the revenue is shared with the destination state. Union Territory Goods and Services Tax, UTGST, applies in union territories without legislatures. Destination-based taxation, GST revenue ultimately goes to the state where goods or services are consumed, rather than the state where they are produced. Value-added taxation, GST is collected at different stages of the supply chain, but the tax burden at each stage is limited to the value added by that business. Input tax credit, ITC. A business gets credit for the GST paid on its inputs and can use this credit to reduce the GST payable on its output, preventing the cascading tax on tax effect. Taxation of imports. Imports are treated as interstate supplies and attract IGST along with applicable customs duties, ensuring that imported goods face a tax treatment comparable to domestic supplies. Zero-rated exports. Exports and supplies to Special Economic Zone, says, developers or units are zero-rated, allowing eligible suppliers to claim refunds of input taxes and ensuring that domestic GST does not become part of export costs. Specified items outside GST, the Goods and Services Tax, GST, Act, 2017 does not apply to alcoholic liquor for human consumption. Crude petroleum, petrol, diesel, natural gas, and aviation turbine fuel, ATF, are also not currently taxed under GST. They remain subject to existing central and state taxes until brought under GST. Digital Tax Administration, the Goods and Services Tax Network, GSTN, provides the common digital infrastructure for registration, return filing, tax payment and other GST-related compliance. E-Waybill, the electronic waybill records the movement of goods above the prescribed threshold and helps authorities track consignments and check tax evasion. Composition Scheme, eligible small taxpayers can opt for a simplified tax mechanism with lower compliance requirements, subject to prescribed conditions. Taxpayers under the scheme generally cannot claim input tax credit. GST Council, the GST Council under Article 279A provides a constitutional platform where the center and states jointly make recommendations on rates, exemptions, thresholds, and other major aspects of GST. About Goods and Services Tax, GST, Council. The GST Council is the constitutional institution through which the center and states jointly shape the GST framework. Constitutional basis. The GST Council is established under Article 279A of the Constitution. Chairperson, the Union Finance Minister heads the Council. Members, the Union Minister of State in charge of Revenue or Finance and the Minister in charge of Finance or Taxation, or another nominated minister, from each state are members. Voting, a proposal requires at least 3/4 of the weighted votes of members present and voting. The center has 1/3 of the weighted votes and all states together have 2/3. Recommendations, the Council recommends GST rates, exemptions, model GST laws, threshold limits, special provisions, and other matters specified in Article 279A. The Council institutionalizes cooperative federalism by bringing the center and states together to decide on a common indirect tax framework. Goods and Services Tax, GST, Act 2017 significance. GST strengthened India's indirect tax system by simplifying taxation, improving compliance, and creating a common national market. Unified tax system, common GST rules reduced the earlier differences between central and state indirect taxes. Simpler compliance, online registration, returns, and payments through the GSTN reduced multiple tax procedures. Reduced cascading, input tax credit, ITC, allows tax paid on inputs to be adjusted against output tax, reducing the tax on tax effect. Lower business costs, better credit flow and removal of cascading reduced the tax burden embedded in production costs. Better tax compliance, digital records, invoice-based reporting, and e-way bills improved transaction tracking and discouraged evasion. Wider tax base, more businesses entered the tax net, increasing formalization and improving revenue efficiency. Cooperative federalism, the GST Council created a common platform for the center and states to jointly decide major tax matters. Consumer benefit, greater transparency and reduced cascading helped lower hidden tax costs in the prices of goods and services. Goods and Services Tax, GST, Act 2017 challenges and criticism. The implementation of GST also revealed issues that required continuous rationalization and policy adjustments. Rate complexity, the original 5%, 12%, 18%, and 28% slabs, along with exemptions and cesses, created classification and compliance difficulties. Incomplete coverage, alcohol for human consumption and major petroleum products remain outside the operational GST framework, limiting tax integration. MSME burden, digital compliance, accounting, and filing requirements can be difficult for small businesses with limited resources. Inverted duty structure, higher GST on some inputs than the final product can lock up working capital through accumulated input tax credit. State revenue concerns, states surrendered several taxation powers and became more dependent on the GST framework for revenues. Digital dependence, technology-related difficulties and limited digital capacity affected compliance, particularly during the initial years. GST 2.0, 2025 reforms. The above challenges, particularly the complexity of the original rate structure, encouraged further rationalization. The 56th GST Council meeting in September 2025 introduced major rate reforms, with the revised structure taking effect from September 22, 2025, marking the next phase of GST as GST 2.0. The earlier 5%, 12%, 18%, and 28% slabs were rationalized into 5% and 18%, with a 40% special rate for selected luxury and demerit goods. Selected luxury and sin goods, such as high-end cars, pen masala, and certain tobacco and aerated beverage products, were placed under the 40% rate. Several food items, medicines, and other commonly used goods were moved to nil or 5% GST, reducing the tax burden on consumers.
Thank you for watching. Helps you in your UPSC journey. Don't forget to subscribe to our channel for more guidance and click the bell icon to never miss an update. Keep studying hard and good luck.